All right. Hello and welcome back to Principles of Accounting 1. Happy to have you with us as we talk about merchandising activities, which is what this chapter is really all about. It's more about merchandising than it is anything else, which is about retail. Yeah, that's more about a retail business. But before we jump into today's lecture on merchandising, I do want to talk about LinkedIn Learning certificates for just a second to help you to better understand how they work and why we have them in the classroom, that kind of thing. Now, we had our very first LinkedIn Learning certificate back in week one, if you recall that. And at the beginning of the course, it was very busy. We had a lot of things going on. Introductions. We had a lecture, and it was kind of a very complex week, as you recall, week one. So, for those of you who are still having trouble with LinkedIn, there's a couple of steps I need you to take. The first step, of course, is to go to Start Here. And then I really need you to come down to this one that says LinkedIn Learning Activation Instructions. Here, there's a short video. I want you to watch that. But there's also, in addition to that short video, there are 9 steps that you have to take in order for this to work correctly. Okay, once you take these 9 steps, what that does is it links your UDC account with your LinkedIn Learning account. All right, so you have to follow those 9 steps. That's the only way that your LinkedIn Learning account is going to work. Okay, now here's a couple of caveats to this. Number one is you have to use either Microsoft Edge or Google Chrome or Firefox for this to work. It will not work with Apple products, meaning it will not work with Safari. Okay, it's just not going to. It's not going to work with any type of other web browsers. You have to use either Microsoft Edge, Google Chrome, or Firefox. I recommend that you use Microsoft Edge for this in order for it to work correctly. Yeah. The other thing you need to know, and I know that some of you have had this trouble before, you need to clear your cache, meaning you got to come up to your settings, right? You go to your settings on your web browser, and you'll notice that there are a couple of options, right? Some of those, if you come down to the privacy and search, you want to clear your cache. Okay. Also, ultimately, what I'm talking about is clearing your browsing data. You could keep your passwords and stuff like that if that's what you do, but that's one of the first things you need to do, because what that does is and also you need to clear. Need to come down to what's called cookies and site permissions, and you want to clear all this site data and cookies and stuff like that. What that does is it provides the security clearance, right, for you to be able to access LinkedIn Learning. That's oftentimes a barrier, right? So you clear your cookies and cache, site data, all that stuff. And make sure you enable pop-ups. If you do those things, it's going to work, right? Sometimes LinkedIn Learning has technical issues, right? Like it might go down or it might not load for whatever reason. You just have to be patient. Refresh the browser, close the browser, open it back up. Try it in incognito or in private mode. Sometimes that works. Okay, you just have to be a little creative sometimes in order to get it to work. Uh, this is the same situation with a lot of technology, but really, if you follow those steps, it'll work for you. It will. And as I had mentioned, and the reason why I'm bringing this up again is because we're coming up to a point, and obviously not this week, but in future weeks, which I think is next week, maybe it's the week after, we have another LinkedIn Learning certificate. Right? Yeah, here it is. It's in 2 weeks from now. We've got another LinkedIn Learning certificate. So I just want to make sure that you all understand that process, because when you go into your LinkedIn Learning certificate, it'll open up like this. And as I had mentioned, you need to make sure that every single video has a green check mark next to it. You have to go in order, right? So you come down, you watch all these videos, you get in all these green check marks, and you're paying attention, you're doing all the right things. Even the conclusion, at the very end, when you get to the end of the video, at the very end, it'll say something like this: "Congratulations," and oftentimes your it'll pop up with your certificate. That's why you have to have the pop-ups enabled. And the certificate is going to look like this. And you want to click on the one that says LinkedIn Learning Certificate, and then download PDF only. You could add it to your account too if you want to. It'll download to the PDF version to your computer. You'll come back to the classroom and you'll upload it to this file area. And that's how you submit it. Okay. And then when I receive it through that submission, I'll grade it. Yeah. So that's the process. Those are the steps. Again, if you have technical issues or anything along those lines, as you're completing these LinkedIn Learning certificates that are throughout the course, you need to let me know right away. So that way I can help you through that, whatever it is that you're facing. And if you don't have time to meet with me for whatever reason, your schedule's packed, you don't have time to make it office hours or whatever, send me an email, screenshots, you could do video recording, whatever, and I'll try my best to help you out. And if I can't figure it out, then I'll get somebody who can, but I need to know that you're having trouble with it in the first place, right? So again, if you haven't done it already, go back to week 1 and make sure that you complete the LinkedIn Learning certificate there. Because remember, these are worth a lot of points, yeah? So don't skip anything in this course. Because I promise, if you skip stuff in the course, you probably won't pass it. You have to do these things. So go back to week 1, complete it if you haven't already. And then I think there was one recently, right? Was it last week? Yeah, the one from last week. Last week there was another one. You've got to complete that one as well. And then 2 weeks from now, there's another one. And then there's going to be another one after that. So again, very, very important that you do these things. If you're having technical issues with it, again, just let me know. And I'll do my absolute best to find time to meet with you. You can send me screenshots, tell me exactly what's happening, take a video, whatever, and I'll walk you through it. Okay? Sound good, everyone? Are we okay with this plan, this strategy? Okay. Again, if you have trouble, you just let me know, and I will be there for you. I'll never leave any of you behind. Never, ever, ever. Ashley, please.
Hello, can you hear me?
Yeah, I can hear you.
Um, so I turned in one of the LinkedIn's, the last one we had to have due, but it was marked late, but mine was on
That's
time.
okay. Yeah, yeah. So that's a technical issue, Ashley, and I'm very happy that you brought that up. So the way that Blackboard works is uh, once the date and time passes, it automatically marks it late, even if it's on time, it'll mark it late. Don't worry about that. It's okay. The same thing happens with a hypothesis, right? Same issue happens with hypothesis. It'll mark it late. Yeah, don't worry about that. Okay, it's just a technical thing with Blackboard. Yeah, there's nothing we can do about that. But don't worry if it says late, because you already know me. I'm not gonna penalize you, even if it is late. I'm not going to penalize you. Okay. Uh, the point that I'm getting at here is that I want you to get it done, regardless of if it's on time or late. And even if the system marks it late, don't worry about that. It's not going to hurt you. Okay, I promise. Hopefully that helps answer your question. So great, cool. All right. Any other comments, questions before we start the lecture? We good? Yeah. All right. Let's do this thing. So this title is very inaccurate because this uh, this week is not about adjusting entries. This week is not about adjusting entries. This week is about merchandising activities. Okay, merchandising. So I wouldn't have called it this title. Yeah, week is about merchandising. When we talk about merchandise, I want you to think about retail. Okay, retail. Some of you might work in retail. I used to work in retail. I did a lot of stuff in retail. My very first job was at the age of 14, and I was a cashier at a grocery store. Yeah. And then at 15, I was in customer service, and then at 16, I was the assistant manager of that grocery store. And that's when it was cool to work at a young age. Yeah, it was still somewhat legal back then. Uh, the point is, working in retail, it's important that we understand how these types of transactions work. Even if you don't work in retail, let's say you're a manager, but at your store, you sell stuff. Or let's say you have your own business and you sell stuff. You sell physical products. Okay. If you sell physical products, you need to know how to account for that. And even if you don't do that type of stuff as a manager, you really need to understand how inventory works, regardless. Yeah, because eventually you're going to see this. Yeah, you're going to see this in management. So let's talk about this. Now, one of my favorite companies is Macy's. I love Macy's. I'm a big fan of Macy's. I like going to the store. They always have, everything's a little overpriced in there, honestly, but I just like going in there. It's a decent store. So I want you to think about Macy's as we talk about merchandise companies. So I want to compare merchandise companies to service companies. And the reason why I want to go through this comparison is because in the previous chapters, previous weeks, we talked a little bit about service companies, right? From the perspective of the income statement. A service company is a company that provides a service. It could be a lawn care service, it could be uh, a hair salon, a barber shop, an accountant, a lawyer, a plumber, um, a handy person. These are all services, right? There's no physical product involved, right? That's what makes it a service business. A restaurant service. It's a service business. Yeah. There's no like physical, tangible product that you're purchasing and taking home, right? So that's what makes it a service business. In service businesses, they don't track inventory. There's no inventory for an accountant. There's no inventory for a lawyer. There's no inventory for a plumber. Well, yes and no. I'll talk about that later. For service businesses, there's no inventory. A lawn care company doesn't have inventory. They have expenses for the stuff that they're using, but that's not inventory. Inventory is something that they have and sell to the customer. That's inventory. Service businesses don't have that. So you'll notice that their income statement for a service business has revenue, which is sales, expenses, and then net income. So revenue, sales, and then they have all the expenses listed out, and then at the very bottom is net income. Revenue minus sales equals net income. That's the income statement on a service company. The reason why that's important to remember is because when we're comparing a service company to a merchandiser or a retailer, there's a couple of additional steps of that income statement. A merchandiser, I call them a retailer, right? You probably call them a retailer as well. The book calls them a merchandiser. Merchandiser. Sounds fancy, right? They sell inventory. It's a retailer. A retail company that sells products to earn revenue. Examples include things like sporting goods, clothing, auto parts stores, retail stores, right? The shopping mall. Again, my favorite example is Macy's. Some people like Nordstrom, some people like J.C. Penney, and all the other big box retailers. So I want you to think about these stores at the shopping mall that sells products. Where do you think they get their products from? What do you think? Who can tell me? Where does Macy's get their products from?
They have a collaboration.
Yes, yes. That's part of the story. Yeah,
From their vendors.
from their vendors. Yes, correct.
Third-party vendors.
From their vendors. They come from the vendors. They come from distributors who supply the goods from the vendors to the store. Call them distributors. A distributor is kind of like a middle person, right? They obtain the goods from the vendors or the manufacturers, and they buy it from the vendors or manufacturers, and then the distributor turns around and sells them to the store, right? Think of it as it's a middle person. Yeah, they're in between the vendor or the manufacturer and the retailer. Okay? Here's how it really works, and I'm not exaggerating at all in this story with the numbers. Okay, I'm gonna give you some numbers, and you're gonna I might blow your mind here. Okay, so you ever wonder? You go into the store and you're like, man, how'd they come up with that sale price? Right? It's like they want $50 for this designer shirt, a T-shirt or whatever. They want $50 for it. Where did they come up with that sale price? You might be wondering. Well, here's how it really works. This is a true story now, so look it up if you want to, but this is the way it works. Let's say Macy's is selling a designer T-shirt for $50. Okay, how do they derive that price? Well, think about the process that shirt went through to get from the manufacturer to Macy's. Okay, it took a long journey. Think about this. Some of the best clothing in the world is made in Bangladesh. Okay, Bangladesh makes amazing clothes. Okay, very amazing fabrics. That part of the world, that's where the best silk and cotton and all of the other types of materials that go into making clothing. That's where it comes from. Some of the best material product making aspects come from that part of the world. So here's how it works. Macy's sells the T-shirts for $50. A distributor is the middle person between the manufacturer and Macy's. The manufacturer made that $50 retail shirt. They manufactured that shirt for about 10 cents. Yeah, 10 cents. Okay. It takes about 10 cents to make a shirt, roughly. Here's how. Okay. The manufacturer purchases their raw materials like the silk and the cotton and the whatevers for a very low price. Usually, like we'll say 1 penny per shirt, okay, roughly. Then they start making the shirt, right? They got the sewing machines, they got the employees, they got the facility, the manufacturing facility. So they purchase the raw materials for 1 penny. They probably pay their employees 1 to 2 pennies per shirt, roughly. And then the company has their overhead, another 2 pennies to pay for the electric and the rent, things like that per t-shirt. So now we're up to 5 cents. Okay. So it takes about 5 cents to manufacture $50 designer t-shirt. The manufacturer then sells those t-shirts to the distributor for, we'll say, just for sake of argument, about $1 per t-shirt, roughly. That's probably true. It's probably actually less than that. But it's probably about $1 per t-shirt that the manufacturer sells to the distributor. The distributor is responsible for getting the t-shirt from the manufacturer over in Bangladesh to the store where it's being sold, Macy's in the United States. So it has to travel around the world, basically, most of the world. So it makes it to the United States through the distributor. The distributor distributes the goods to Macy's. They sell to Macy's. So the distributor bought the 5-cent t-shirts for $1 from the manufacturer. The distributor then sells the t-shirts to Macy's for $5 per t-shirt. You see? It's probably about right. It's probably accurate. And we're talking tens of thousands of t-shirts, right? So $5 a shirt, Macy's pays the distributor. Distributor's happy, they got their margin. The manufacturer's happy, they got their margin. Macy's bought the t-shirt for $5, sells it to you for $50. Okay? I'm not kidding when I say these numbers. These are real numbers. That is the reason why sometimes you'll go into Macy's or Nordstrom or wherever, and they'll have their spring clearance sale. And you're thinking to yourself, wow, how could they be making a profit by selling it for 50% off? You see, all that $50 t-shirt's now $25 because it's on the rack, right? It's on the clearance rack. Half off. Oh, $25. Oh, Macy's must be losing money on this deal. No, they're not. They can sell it to you for 90% off and still make a profit. That's how retail really works. Okay. The margins on certain products are higher than others, but yes, Sam knows. Sam used to work there and can confirm that that's true. Yeah, absolutely. That's how they make a profit. They have to make a profit. The reason why you go into business is to make a profit. That's why, okay? You can't, nobody goes into business to not make a profit. All right? So, certain products have higher margins than others. Clothing has one of the highest profit margins on the planet. Okay. The second highest, furniture. Furniture has some of the highest profit margins on the planet. And then after that would probably be, I don't know, other consumer products. Um, and then after that would be electronics, maybe. Electronics, usually the margins aren't that high, believe it or not. Um, and then food, and that's really about it. But yeah, it's a true story, and that's why I wanted to tell it to you because it helps you to put this into context to better understand how pricing works, and how retail actually works. Okay, so all of that to say, yeah, exactly, Sam, you got it. That's how they have these sales all the time. When you see 25% off, 50% off, 75% off, the clearance stuff, they're still making a profit. The pricing is a very psychological aspect. That one thing that you'll eventually learn is that everything in finance is behavioral. 80% of everything in finance is behavioral. The rest of it is textbook knowledge. Yep. That's a story for another day. Okay, so a retailer like Macy's, on their income statement, they have sales, merchandise sales, minus cost of goods sold. Cost of goods sold is an account that represents the cost of the merchandise that they sold. Going back to my $50 t-shirt example, the sale price is $50. The cost of goods sold is $5. Remember, because they bought the inventory from the distributor for $5. They sold it to you for 50. So $50 sale minus $5 cost of goods sold equals $45 of gross profit from selling that one shirt. Minus expenses. Expenses are the day-to-day operating expenses of the business. This would include things like rent, utilities, payroll, wages, um, repairs and maintenance, etc. Okay, there's a ton of expenses I can list down. Equals net income. So sales minus cost of goods sold, that's the cost of the inventory that they're selling to you, the customer, equals gross profit. Gross profit is what we say sales minus cost of goods sold is. It's gross profit. Gross is a word that we use to mean before deductions. Okay, before deductions. So that's what the word gross means. So gross profit minus expenses equals net income. This is your traditional merchandise retailer income statement. And of course, on the balance sheet for a retailer or merchandiser, you'll see under assets, under current assets, you'll see inventory. Inventory will be on the balance sheet. Because remember, inventory is an asset account. And the asset is what the business owns. Assets help the business to generate sales. The company buys and sells inventory, right? Helps to generate sales. That's why inventory is an asset account. Okay, so now you know. Now you know a lot more about retail than you thought you probably would. All right. For a retail business, we have what's called an operating cycle. Almost every single business, actually, I would say every single business has what we call an operating cycle. It's how the business operates. Yep. It's very simple to follow. Think about the physical flow of things. Okay. Number one, cash. The company uses cash to purchase inventory, merchandise. Or sometimes they purchase it on accounts payable, right? They'll pay it later. Company uses either cash or accounts payable to purchase inventory, merchandise. The company then sells that inventory to customers either through cash or accounts receivable. Remember, accounts receivable is when a customer owes the company money but hasn't paid it yet. Yeah, account receivable. And eventually we collect that receivable, becomes cash, and then we do it all over again. Yeah, that's what we call the operating cycle for a merchandise company. Cyclical. Yep. I'm sorry, this is so blurry. Either I'm going blind or it's really blurry. This is a flow chart, if you will. Okay, this flow chart shows us that it shows how our inventory works. We purchase inventory every single month. And every single month, we also have beginning balance of inventory. We started the month with some inventory on hand, and we purchased some more. Purchases plus beginning balance of inventory equals merchandise available for sale. It's what I have on hand. It's available for sale. When I sell it, it becomes cost of goods sold. I take it out of inventory, it becomes cost of goods sold. So another way to word this is, or a second way to calculate how much inventory you have available for sale, you just take cost of goods sold plus ending inventory, right? It's obviously the opposite. So this way to think about how to calculate merchandise available for sale, there's two ways. Purchases plus beginning inventory, or cost of goods sold plus ending inventory. Either way, it helps you to calculate merchandise available for sale. Okay, in retail, there's two different types of inventory tracking systems. We have the perpetual system and the periodic system. The perpetual inventory system updates the records based off of every purchase of inventory. Here's what I mean by this. Perpetual means continuous, right? At Macy's, when you go to purchase that $50 t-shirt, designer t-shirt, they scan it. They use a barcode scanner. Yeah, there's a barcode, they scan it. The second that barcode gets scanned by that scanning device at the checkout counter, it takes it out of inventory. It's continuous, you see. It's almost automatic. They scan it, takes it out of inventory. Yeah. So that's what we call a perpetual inventory system. The other type of system is called periodic. We periodically update our inventory at the end of each accounting period, and we usually do that by a manual count of how many units I have left on the shelf. Okay? Here's a couple of examples of this. A car dealership uses the periodic inventory system. Last time I went to the dealership, there's no barcode scanner on the door. Okay? They update it manually in their system. Okay? Usually companies that use a periodic inventory system would be companies that don't make frequent sales. An example of that would be a car dealership. They're selling cars, that's their inventory. And to track that inventory, they use the periodic inventory system. They manually update it at the end of each accounting period. You see? So those are the two types of systems that we work with in accounting. Now, of course, We're going to focus on the harder one because that's what we do in accounting. So we're going to look at the perpetual inventory system. And I'm going to walk through a bunch of transactions with you to show you what it looks like on your general journal. Okay. So, first transaction we have here is our company. We are we're Zmart. We are a convenience store, we'll say. Okay. We own and operate a convenience store. And on November 2nd, I purchased $500 worth of inventory from my distributor in cash. $500 in cash of inventory from my distributor. So simple transaction here. November 2nd, debit merchandise inventory to increase my inventory balance. Remember, inventory is a asset account. And I credit cash to decrease my cash. So I paid it in cash. You know? So very easy transaction. You'll notice it says at the top, purchases without a discount. Now, in business, it's smart to create what we call credit terms with your vendors, with your distributors. Why? Because credit terms is a method that the distributor or vendor uses in order to get paid faster. Okay, here's what I mean by this. Our company, Zmart, the convenience store, some vendors I don't have a relationship with, so I just pay them in cash for the inventory. Other vendors I have a relationship with. I know them. I purchase a lot from them. So I establish what's called credit terms. This is an agreement between the retailer, the seller, the company, and the distributor or the vendor, whereby I purchase the inventory and I'll pay them later. We call that credit terms, right? It creates what's called an account payable with that vendor. Oftentimes with credit terms, the vendor or distributor will provide you with a discount if you pay them early. Makes sense, right? Who doesn't like to get paid early? Oh, I'll give you a discount if you pay me early, right? That's what we call credit terms. The credit terms have the following information that you need to know. On the agreement, you'll have what we call the credit period. This is the time frame that you have to pay the bill back, right? You'll also, that's like 30 days, we'll say. The credit period is usually 30 days. Sometimes it's 45, but in most cases it's 30 days. You have 30 days from the date of the purchase to pay the bill to your vendor. That makes sense, right? So that's my credit period is the number of days that I have to pay the total bill. On that information, or within that credit period, oftentimes we have what's called a discount period. This is the number of days that I have available if I pay that bill to the vendor, they'll offer me a % discount on the total amount. Right? That's called a discount period. For example, if I pay my bill within 10 days, I'll receive a 2% discount. Otherwise, I owe the whole amount within 30 days. Right? And of course, you'll see the invoice date. That's when the purchase was made. If I pay that invoice amount within that discount period, I owe the amount minus the discount amount, right? In other words, I keep that difference. Otherwise, I owe the entire amount at the end of the 30 days. So that's what we call credit terms. This is what the discount will look like. It is not a formula, it is a way of writing the discount amount out. On an invoice, you might see the credit terms. This is the credit terms. This is the way it's written out. And these numbers can be totally different depending on what the credit terms are. The credit terms are not always the same. In this example, I receive a 2% discount if I pay the amount I owe within 10 days. Otherwise, the entire amount is due within 30 days. That's what 210 net 30 means. 210 net 30. The first part is the discounted percentage paid within the number of days. N means all or net within the credit period amount. So 210 net 30 means 2% discount if I pay within the first 10 days. Otherwise, the entire amount is due within 30 days. That's what this means. It's just a different way of reading it. This is what a typical invoice looks like. Here you see who it's from, the vendor, the invoice date, and the invoice number. Who it's sold to, us, the customer. How it was shipped. Oh, I'm sorry, number 4, the order date. Number 5, the credit terms, 210 net 30. In this example, 2% discount if I pay within 10 days, otherwise the whole amount's due within 30 days. Number 6, and this is important as well, the freight terms. Shipping is really important, especially in retail, okay? Because the shipping terms will tell you who's responsible for the inventory while it's in transit. Okay, it's basically the point of when liability transfers between the seller and the buyer. Who's liable for those goods while it's in transit? Here we have FOB destination. FOB means free on board. Free on board. Free on board simply represents the transportation. Yeah? It's on a truck. It's on board. Destination means that the seller is responsible for the goods while they're in transit until it reaches its destination. Right? Free on board destination. That's what we call shipping terms. We'll talk more about that here in a few minutes. And then number 7 on the invoice shows what you ordered, how much of quantity, the price of each item, and of course the total. And then number 9, you see the net of discount. Because we have 210 net 30, 2% discount if paid within 10 days, otherwise the whole amount's due within 30 days. If I pay that $500 within 10 days, I'm only going to pay $490 because of the 2% discount, you see? If I pay after that 10 days, I owe the full $500. Now, let's look at this example from an accounting perspective. November 2nd, as you recall, I purchased inventory from my vendor. And on credit terms, 210 net 30. So, November 2nd, I enter the transaction. I debit merchandise inventory to increase my inventory, and I credit accounts payable. Because remember, I'm on credit terms, I can pay them later by $500. I'm going to show you two different possibilities. 1B is that you better believe we're taking advantage of that discount. Yeah, who doesn't want to save $10? So here's how we record that transaction. On November 12th, I debit accounts payable 500. I credit merchandise inventory by $10. I didn't sell $10 worth of inventory. I'm reducing the value of the inventory by the discount amount when I credit merchandise inventory. You see? Because it's technically not worth 500 if I got a $10 discount, it's worth 490. So in order to represent that discount, we credit merchandise inventory by the discount amount. And then credit cash 490 is 2% discount within 10 days off of a $500 bill. Make sense? Good. This is what it looks like on your ledger accounts, the impact on the balances. So you're looking at your balances and you say, okay, accounts payable 500 on November 2. I paid it November 12. Great. Merchandise inventory, I reduced the value of the inventory by $10 because of that discount amount. And of course, my cash went down by the 490. Remember the accounting cycle, right? This is part of the accounting cycle. Okay, and then option 2 is I missed the 10 days. Oh, well, I purchased it on November 2nd. Oh, here we are on December 2nd, 30 days later. And I missed the discount period. No problem. Just pay what you owe, the 500. Debit accounts payable, credit cash 500. Very simple. Okay. Now, let's make it a little bit more complex, a little bit more interesting. Sometimes in business, especially in retail, let's say we're Macy's, we ordered a whole lot of designer t-shirts from our vendor. We purchase it for $5 a piece. We sell them for $50 a piece. Okay? Once in a great while, you might get a batch of those t-shirts in and you're like, man, something a little off here. So the stitching's all messed up. The cut doesn't make sense. The design, something wrong with the design. And you're thinking, what happened? What happened here? So you receive the inventory and you're like, something's a little off here. Oh, we can't accept this. Or we accept it and we ask for a discount. Those are two possibilities. We call these purchase allowances and returns. A purchase allowance is when the seller grants a price reduction to the buyer for defective or unacceptable merchandise. In other words, my distributor would come to Macy's and say, hey, sorry about we messed up that batch or whatever. Instead of selling it to you for $5 per designer t-shirt, we'll sell it to you for $3. Macy's might accept that type of deal. Okay, yeah, sure, why not? They can still sell it, or what they'll probably do is turn around and sell it to TJ Maxx or Marshall's Home Goods. That's usually what happens with defective merchandise. Some of you may or may not know that. So that's called purchase allowances. Or the other possibility, merchandise return. A purchase return is when the merchandise is returned by the purchaser to the supplier. Macy's be like, hey, those designer t-shirts are messed up. I'm sorry, we can't accept those. You're going to have to take them back. That's called a purchase return. Okay. So here, that's the Macy's example, and that's how I like to explain things. Now let's go back to our other example, our corner store, our convenience store. Yeah. So we got our convenience store. Remember, back on November 2nd, we ordered $500 worth of inventory from our supplier. And we noticed, hey, you know what? Some of this stuff is defective. So we call our supplier up and say, hey, about $30 worth of this stuff is no good. It's like, I can accept, I'll take it, but, I don't know what to say. And the supplier says, okay, no problem. Take a $30 allowance. It's a credit toward the account payable. Yeah. So we debit accounts payable by $30 to reduce our bill by $30. And we credit merchandise inventory to reduce the value of our inventory by $30. Remember, it's defective. But this is an example where we kept it. Then, the next situation, I purchased some more inventory from our distributor, about $250 worth on credit terms 210 net 60. A few days later, we discovered that $50 of our goods are not good. We can't even sell them. It's that bad, right? It's defective. They're not working. So we call our distributor up and say, hey, we're going to have to send you back $50 worth of product that we cannot sell. Okay, no problem. So on June 3rd, I make the recording. Debit accounts payable $50 to reduce what I owe them by $50. And I credit merchandise inventory $50 based off of the value of the goods that I returned to the vendor. So June 11th, I decide to pay. A debit accounts payable $200 because that's the remaining balance of my bill, $200. Then you'll notice I credit merchandise inventory by $4 and I credit cash $196. You might be saying, Dr. B, why did you do that? She says, oh, because I paid on June 11th. My credit terms are 210 net 60. But you think I have to update my credit terms, right? Yeah. So I owe them 200. It was originally 250. It went down to 200 because I returned $50. So my credit terms are 210 net 60. So I take the 2% discount on the $200 that I owe them. 2% of 200 is $4. That's where that comes from. Cool, right? Earlier I mentioned about the shipping terms. Transportation is real important in retail, because somebody is responsible for that inventory while it's in transit. And it's important to understand how that works because somebody has to insure the inventory while it's in transit. Somebody's paying for the insurance, whether it's the seller or the buyer. Okay? So there's two types of shipping terms typically. We have free on board shipping point and free on board destination. I already told you about the destination part. Free on board destination is where the seller is responsible for the shipping insurance until it reaches the destination, right? When it comes to free on board shipping point, the ownership transfers at the shipping point, meaning the buyer is responsible for the product at the point that it's sold. You see? This translates into two different types of transactions. If the buyer is responsible for the shipping, the buyer will debit merchandise inventory to increase the value of the inventory by the shipping amount, cost of shipping. And they'll credit cash to pay for the shipping. That's an important designation, you see. Merchandise inventory went up by the shipping amount. Why? Because the total value of inventory includes insurance and shipping costs. Okay, important to know that. And then, of course, the free onboard destination part, the seller is responsible for that. So the seller would just debit delivery expense and credit cash. Okay, so our convenience store. We purchased inventory and our shipping terms were free on board shipping point. And it cost $75 to ship our inventory to us. So we debit merchandise inventory $75 to increase the value of the inventory by $75. Because remember, the total value of inventory is the purchase price of the inventory plus any type of insurance and shipping. And then we credit cash to pay for the shipping. So yeah, this kind of shows us an itemized cost of purchases. You'll notice that we have the invoice amount minus any discounts that we received and minus any returns that we sent back. And then we add in any type of shipping cost. Gives us the net cost of purchases. Yeah. This type of report you might see internally. It's not something that gets published or anything like that. It's for management purposes only. That's all you need to know about that. Now, one of the other things that we talked about, the pricing. Remember the pricing. We need to understand transactions in order to figure out our sales price. Yeah, absolutely. Once we know our sales price, we can figure out how much profit we're going to make from every dollar sold. Right? And the best way to figure this out is using the perpetual inventory system. So here we have what we call the gross profit computation. Remember earlier on I showed you the income statement, right, for a merchandiser. And a merchandiser's income statement has sales minus cost of goods sold equals gross profit minus expenses equals net income. Yeah, typical merchandiser sale retailer income statement. How do we calculate gross profit? Very simple. We take sales. More importantly, we take net sales. Net sales is the sales minus discounts, returns, and allowances. That gets you net sales. Minus cost of goods sold. Remember, that's how much we purchased our inventory for from our vendor. Equals gross profit. Gross profit is a very important number to understand. Because as a manager, you want to understand how much profit to expect from every dollar sold. That's why gross profit is really important. And that number has to be higher than your expenses, otherwise you're going to be at a loss. Yeah, just something to think about. Okay, so every transaction when we sell inventory involves two different transactions, really. Two parts to the transaction. Every time we sell inventory, there are two parts to the transaction that get recorded. The first thing we do is recognize the sale. We made a sale, right? So we would debit cash or accounts receivable, and we would credit sales to recognize the sale. That's from the revenue recognition principle, remember? But there's another side to that transaction. Obviously, we sold inventory. We got to recognize the fact we sold inventory related to that sale. This goes back to the expense recognition principle. We debit cost of goods sold to recognize the sale of the inventory, and we credit inventory to take the inventory out of the company because we sold it. Here's the example. Our company sold $1,000 worth of inventory on credit. The inventory cost us $300. Okay? So recognize the sale first. Debit accounts receivable $1,000. Credit sales $1,000. On the other side of that same transaction, we debit cost of goods sold $300. Just remember, that's how much the inventory cost us. And we credit merchandise inventory $300 to reduce our inventory. Now, what if we had an agreement with our customer and we provided our customer with credit terms? We call that a sales discount. You make an agreement with your customer on credit terms. We call it a sales discount. Okay? What this does is, on the sales side of things, is it encourages your customers to pay you quicker when you offer them a discount. So here we have the example. We sold $1,000 worth of inventory to our customer, and we gave them credit terms of 2% discount if they pay within the first 10 days. Otherwise, the net amount is due within 45 days. 210 net 45. Those are the credit terms we gave to our customer. So if the customer decides to pay within the 10 days, 10 days later, 22nd, we debit cash $980. Okay, why not $1,000? Because of the 2% discount. 2% of $1,000 is $20. So we debit cash $980. We debit an account called sales discounts, $20. And then we credit accounts receivable, $1,000. You see? If the customer pays us after the discount period, it's a simple transaction. Debit cash $1,000, credit account receivable $1,000. Now, just like it was with our vendors, the same type of concepts apply with our customers. What if we, the awesome convenience store that we are, what if we sell merchandise to a customer that's defective? Whoops. It happens in business, no one's perfect. We sell something that's defective to the customer. We could either offer the customer a discount after the fact and take that off of the amount that they owe us if it's account receivable. That's called sales allowance. Or the customer can return it to us, called a sales return. Yeah, either of those options are possible. With returns and allowances, it works very similar the way it does with our vendors. Here we have a customer who came back to us and said, hey, you sold us $15 worth of stuff and it's not good. Okay, no problem. Option 1 is a return. We debit sales returns and allowances $15 and we credit cash $15. Represent the goods that have been returned to us. Or let's say the customer is like, hey, it's defective, but it's not a big deal. I'll take a discount instead. No problem. We debit merchandise inventory, $9, because that's what the inventory cost us. And we credit cost of goods sold, $9. We sold it to them for 15. It's only worth 9. Oh, yeah, we paid 9 for it. We sold it to them for 15. That's what that shows. And here we have another return. This is when a sales allowance has been granted. Let's assume that we have $40 worth of inventory that we sold on November 12th. The customer decided to keep it, and we offered them a 10% discount. Yeah, and they haven't paid us yet. So we debit sales returns and allowances and credit their account receivable. Okay. Now, just like we do with a service business, sometimes we need to make adjusting entries. Yeah. And as you know, adjusting entries, the reason why we make them is to adjust for things other than cash that have occurred that we need to recognize the consumption for, right? Remember, we had the example of the prepaid insurance. Every month we use the prepaid insurance, so we debit insurance expense and credit prepaid insurance at the end of every month to recognize the consumption of that insurance. You remember, this was maybe 2 weeks ago, I think. We talked about that. The same rule concept applies in retail. Okay? So I'm going to show you what that looks like. I'm not a big fan of that one particular slide. Here we have an example. Lost inventory. It happens. It was either stolen, it never arrived, we used it for whatever reason, as a demo, or it's gone. Okay, something happened to it. We call that shrinkage. It's a technical term that means loss of inventory. Okay, so at the end of the accounting period, we need to make an adjusting entry to represent the loss of this inventory. We debit cost of goods sold by the value of the inventory, and we credit inventory to take it out of inventory because it's not there. Now, this type of adjusting entries are required for things like the expected sales discounts, expected returns and allowances, and expected expected returns and allowances on the revenue and cost sides. Well, fancy terms, right? In business, sometimes we need to estimate, right? We might estimate that a certain percentage of our sales are going to come back to us, meaning that a certain percentage is going to be defective. We're going to offer a certain percentage of discounts to customers. So we need to estimate for those things. That's the other reason why we make adjusting entries. And just like we do with any other business, we have to go through the closing process. Right? Remember, we close out our temporary accounts through income summary, and then the income summary gets closed out to retained earnings minus any withdrawals. Yep. So we go through the same type of closing process, just like we do with any other business. So at the end of each month, we close out our income statement. To do that, we debit sales, credit income summary. to close out our expenses, we debit income summary and credit all of our expenses. That's the process we take to close our temporary accounts. We debit income summary total to our paid in capital account or retained earnings. Then we take out any withdrawals. Simple closing process. Yep. The ones in red, you'll notice these are your special accounts that you would see in retail. Yep. Sales, discounts, returns, allowances, cost of goods sold. These are a listing of all of the adjusting entries that you might make in retail. I'm sorry, and just regular entries that you would make in retail. So these are your regular entries that you make in retail. Just kind of a summary. Nice little. It's a quick reference material. And this is the type of adjusting entries that you would make in retail. And then, of course, the closing process. Just quick reference, makes it easy for you, especially if you're taking a quiz, for example, and you're like, oh, what's the journal entry for that? It's right there for you. Right on those 2 slides. And then, of course, in retail, our income statements, as I explained, look a little different, but I wanted to show you 2 methods, 2 ways to make an income statement. We have what's called a multi-step income statement and a single-step income statement. A multi-step income statement, just as it describes, is that there's multiple steps. The first step is to compute gross profit. Well, you know how to do that. It's sales minus the discounts, returns, and allowances equals net sales. Net sales minus cost of goods sold equals gross profit. So that's the first step of a multi-step income statement. Then we, of course, compute all of our expenses. Gross profit minus total expenses equals what we call income from operations. And then plus and minus other revenue and interest and expenses and things like that equals net income. See, multi-step, 3 steps really. So that's the multi-step income statement. And then some businesses might show you what we call the single-step income statement. Single step. Of course, the single step's easier to compute, right? We got sales, total revenue, minus all of your expenses. You'll notice the difference here between the single step and the multi-step. In the single step, we call cost of goods sold as an expense. That's the primary difference. Then we don't break out gross profit. But you'll notice the net income amounts are the same, right? 14,900, 14,900. It's just how they're categorized. That's the biggest difference. And then, of course, on a balance sheet for a retailer, the biggest difference you'll see between a retailer and a service company is going to be inventory. Under current assets are always organized by liquidity, as I had mentioned before. Liquidity means how quickly we can convert something into cash. That's why cash is always first on a balance sheet. Cash, accounts receivable, merchandise inventory, office supplies, store supplies, etc. Organized by inventory. Awesome, thanks. And then one of the last things before I let you go, of course, are ratios. There are a lot of really useful ratios in accounting that we as managers use to really understand and evaluate the performance of the company. From a merchandise retail perspective, one of those is called the acid test ratio. the acid test ratio is different from the current ratio because the acid test ratio excludes things like inventory and prepaid expenses because it takes longer to clear those. Yep. So the acid test ratio, we take cash plus any short-term investments plus accounts receivable divided by current liabilities. We call it the acid test ratio. You should at least have a value of 1. Anything less than 1 is not good. And this is how we applied it to a couple of different companies, acid test ratio. And one of the other ratios I want you to know is called the gross margin ratio. Love this ratio because it tells us how many dollars we would expect to have in profit from our sales. So we take sales minus cost of goods sold divided by sales. Gives us the gross margin ratio. Yeah. Of course, the higher the better. And then this last thing just kind of shows you the differences between the periodic system and the perpetual system. Remember, I want you to focus on the perpetual side because the periodic side is really reserved for companies that update periodically, manually. But this kind of shows you a couple differences between them. Just don't worry too much about that. I just want you to know what it looks like. Oh, and then one of the last things we'll do as well is when it comes to estimating discounts. I had mentioned that some companies they'll estimate a certain percentage of discounts, and so the way that we would do that is by using an account we call allowance for sales discounts. The allowance for sales discounts provides us with an opportunity to what we call factor a percentage of discounts that we'll offer or we might receive, depending, right? And so that's what that accounts for. We debit sales discounts and we credit the allowance for sales discounts. It's a method that we use for estimating sales discounts. And of course, we do that through an adjusting entry. Yeah? That's what that shows us. And then we also have, this is just another example, but this is an estimate for returns and allowances. Sometimes we expect that we're going to have some returns. Some customers are not going to be happy with what they receive. Estimate for allowances, right? So we estimate it and we make an adjusting entry. Debit, sales, returns and allowances. Credit, sales, refund payable. Oftentimes it never gets paid out because, or the balance might be different. Yeah, we just make an adjusting entry based off of the actual. So debit, inventory, returns estimated, credit, cost of goods sold. Again, the concept of estimating. Not every company does this, but some do. It's just usually a percentage is how it's expressed. And then going back to make a comparison of the perpetual inventory system to our, based off of those types of adjustments. That's what this shows us. Nothing to worry too much about. Okay. Any comments, questions, or concerns about inventory, merchandise companies, anything like that? Y'all good? Okay. Hopefully I didn't bore you too much. Hopefully you learned something from my stories, right? Okay, just as a reminder, what's due for this week? We are here in week, we're in week 5. So 2 things. You have a discussion board. I see some of you have started this already. Thank you. Thank you for that. Here I'm looking for responses to these nine questions. Not really questions, but 9 statements. And here Maria did a wonderful job of looking at all 9 of them. Thank you so much. That's exactly what I'm looking for, Maria. So all of you, please follow Maria's example here. And then, of course, I want you to respond to 2 of your classmates. All right. I would like you to have your original post completed by Thursday, class Thursday, and then respond to 2 of your classmates by Sunday. And then, of course, you also have your Chapter 5 quiz. Any comments, questions, or concerns about that? Okay, great. Again, if you ever need anything, you need help with something, whatever it is, I want you to remember you can always email me, call me, set up office hours. I'm always here for you. Okay, I always am. And with that, I thank you so much for your time today. I appreciate all of you and have a wonderful rest of your night. Thank you so much.
Do the same.
Thank you. Thank you. Thank you.